Welcome to this summary of The Intelligent Investor by Benjamin Graham, a book often called the Bible of value investing. It's famous not just because it's full of timeless wisdom, but also because it's the book Warren Buffett himself credits as the foundation of his investing success. And before we start, if you find this kind of real, useful knowledge valuable, please subscribe to this YouTube channel. Your support inspires us to keep sharing ideas that can help you build a better financial future. Let's dive in. Benjamin Graham begins by helping us understand two types of investors: the defensive investor and the enterprising investor. The defensive investor is someone who wants to invest safely, with as little effort and worry as possible. The goal is to protect your money while earning a steady return over time. The enterprising investor, on the other hand, is willing to put in more time and work, researching companies, looking for good deals, and trying to beat the market. Graham makes it clear that both paths can lead to success, as long as you're honest with yourself about which type of investor you are. Many people get into trouble because they try to be enterprising without putting in the work, or they take risks they don't fully understand. His first lesson is to choose your approach carefully and stick with it. Another key idea in the book is the concept of Mr. Market, a character Graham uses to explain how the stock market behaves. Imagine you have a business partner named Mr. Market. Every day, he shows up and offers to buy your share of the business or sell you his. Some days, he's cheerful and offers a high price. Other days, he's gloomy and offers a low price. The important thing to remember is this: you don't have to listen to him. You can choose to buy, sell, or do nothing at all. The market's mood doesn't change the value of what you own. Graham's advice? Don't let Mr. Market's ups and downs control your emotions. Stay focused on the true value of your investment. In short, the intelligent investor teaches that investing is not about chasing quick profits or reacting to every rise and fall of the market. It's about being calm, patient, and thoughtful, and focusing on long-term value. In The Intelligent Investor, Benjamin Graham introduces us to the core idea of value investing, a strategy focused on buying stocks at a price that's lower than their true worth. Think of it like finding a good deal on something you know has real value, like buying a reliable car that's priced below what it's really worth because the seller needs to move quickly. That's the heart of value investing. You look for solid companies that are selling for less than they're actually worth, and you wait for the market to recognize that value over time. But how do you know what a company is really worth? Graham teaches that smart investors look at a company's fundamentals. That means things like its earnings, assets, debt levels, and future potential. You're not buying a stock because of a hot tip or because the price is going up fast. You're buying it because, after looking at the numbers, you believe it's a good, sound business, and right now it's on sale. One of Graham's most famous tools is the idea of a margin of safety. This means you don't just look for a stock that's fairly priced, you look for one that's clearly undervalued. That way, even if you've made a mistake in your estimate or something unexpected happens, you have a buffer that protects you from loss. For example, if you think a company's stock is worth $50, you don't want to pay $49 for it. You want to buy it at $30 or $35 so you have that cushion, that margin of safety, if things don't go exactly as planned. Graham warns against getting caught up in speculation, buying stocks based on what you hope will happen or based on hype, rather than solid fact. He reminds us that the stock market can be unpredictable in the short term. Prices go up and down for all sorts of reasons that have nothing to do with the real value of a company. But in the long run, the market tends to reflect a company's true worth. That's why patience and discipline are so important for the intelligent investor. The big message on this page is simple. Focus on what a company is truly worth, buy it when it's selling for less than that, and give it time. That's how value investing helps protect your money and grow it over the long term. Another important part of The Intelligent Investor is Benjamin Graham's advice on managing risk. One of the best ways to protect yourself as an investor, Graham says, is through diversification. That means spreading your money across different types of investments, like stocks, bonds, and maybe other assets, rather than putting all your money in just one company or one type of investment. Why? Because if one part of your portfolio struggles, the other parts can help balance it out. It's like not putting all your eggs in one basket. If one basket falls, you don't lose everything. Graham talks a lot about the balance between stocks and bonds. Stocks offer growth over time, but they can go up and down a lot in the short term. Bonds are generally safer, giving you steady income, but they don't usually grow as much. Graham suggests that the right mix depends on who you are. If you're more cautious or closer to retirement, you might want more bonds. If you're younger or willing to take more short-term ups and downs for the chance of higher growth, you might choose more stocks. The key is to build a portfolio that matches your goals and your comfort with risk, and to stick with it. Another risk Graham warns about is letting emotions control your decisions. Fear and greed are two of the biggest enemies of the intelligent investor. When prices fall, many people panic and sell. When prices soar, they get excited and buy without thinking carefully. Graham's advice is to stay steady. Don't let short-term market swings push you into bad decisions. Instead, focus on the long-term value of what you own and trust in your plan. He also emphasizes the importance of staying realistic about what you can expect from your investments. Graham reminds us that no system, no matter how smart, can protect you completely from market ups and downs. But by diversifying, buying with a margin of safety, and staying calm during market changes, you can give yourself the best chance of long-term success. So, the message here is clear. Protect yourself by spreading out your investments, balance growth and safety in a way that suits you, and don't let emotions drive your decisions. As we wrap up The Intelligent Investor, Benjamin Graham leaves us with powerful advice about the mindset we need to succeed in investing. At its core, his message is that the intelligent investor is not the person who tries to outsmart the market every day or chase the hottest stock. The intelligent investor is the person who stays calm, thinks long-term, and sticks with simple, proven principles, even when the market gets noisy and emotional. Graham reminds us that success in investing is not about being brilliant or having insider knowledge. It's about being disciplined and patient. The market will always have ups and downs. There will always be trends, fads, and scary headlines. But if you have a plan, built on solid, long-term value, and you stay the course, you'll do well over time. The people who panic during market drops or get greedy during bubbles are the ones who usually get hurt. One of Graham's final key points is that investing should be boring. That might sound strange at first, but here's what he means. Good investing isn't about excitement or drama. It's about steady, thoughtful decisions that build wealth slowly over time. If you're constantly looking for thrills in your investments, you're more likely to take unnecessary risks that can lead to losses. He also encourages investors to be self-aware. Know yourself, your goals, and your limit. If you don't want to spend time researching companies and managing your investments actively, that's okay. You can be a defensive investor, focusing on safe, low-cost options like index funds or bonds, and letting your wealth grow quietly. If you do want to put in the effort to be an enterprising investor, make sure you're willing to do the work it takes. Studying companies carefully, looking for real value, and being ready to hold your investments for the long haul. In the end, the intelligent investor teaches us that the best way to succeed is to focus on what you can control: your spending, your saving, your investing plan, and your mindset. Leave the guessing and gambling to others. Build a solid plan, protect yourself with a margin of safety, stay diversified, and be patient. That's how you give yourself the best chance of long-term financial success.